Hi guys, this is Tim Melvin coming to you from down here in sunny Central Florida. We just had a nice line of storms come through, but the sun is back out. It's going to be a gorgeous day down here. As always, we finally broken below the 90-degree barrier for a couple of days, so a very pleasant 88. Dog and I have had a good time out walking in this nice weather today. And we're here today. I'm going to devote this week's video exclusively to talking about the Banking on Profit service because, as you know, we have some big pricing changes coming up there, and I'll get into that a little bit in a minute. But I was talking to some folks today and talking about maybe doing some writing projects together, and mentioned that I like to write about the small community bank stocks. And I was told pretty much, hey, that's too boring for us. That's not exciting. You know, maybe it makes money in the markets, but it doesn't do anything to attract readers to our site. So, okay, I get their point. This is not the most exciting point of discussion, let's say, in the stock market. It's not Google. The small banks aren't curing cancer. They're not doing anything really exciting. They're taking in deposits. They're making loans and making money on the spread. Not exactly an exciting business, but it's an exciting way to invest your money. I've been doing this for almost 25 years now with the small banks, and it is incredibly profitable. They're fairly easy to analyze, as Nate Tobik said in our interview yesterday. Once you understand one, you pretty much understand all of them. So it's kind of easy to find the bargains in the space if you're willing to put in the associated work. And of course, figuring out how to analyze that first one might take you a little while as well. But anyway, I got into this because I had transferred from a large wirehouse firm where, you know, it was the old square peg in a round hole. I do not fit well into large corporate organizations. And great bunch of folks. Dean Witter was a fantastic firm, but I just wasn't thriving there. So I moved to a smaller regional firm in the Mid-Atlantic area, Ferris Baker Watts. It's gone now, unfortunately. It's part of RBC Capital. It's a great place to work. But very quickly, when I started working there, I noticed there was an older gentleman in the office, and he had done real well for himself. He had a nice condo in town, overlooking the harbor there in Annapolis, and then he had a second beach home, overlooking the Chesapeake Bay. So the guy was doing pretty well for himself, but he really didn't seem to work much. He got in about 9:25 most days. One of the last devoted practitioners of the 3 martini lunch, and I don't know that he was ever actually late for happy hour in the 16 or 17 years I worked alongside him. So it didn't take me long to figure out this guy was making a lot more money than me without working as much as I was. So I took him out for happy hour, bought him a couple of cocktails, and said, look, what's the secret of your success? And he was a very generous guy, so he was happy to talk to me about it. He invested in the small banks of the Mid-Atlantic region for his clients, and predominantly the ones right there in and around our hometown of Annapolis. And he knew everybody in town, all the bankers, real estate agents, attorneys, and his family had been there for a long, long time. So he kind of knew everybody, and he knew who owned which banks, who wanted to buy, who wanted to sell, and he helped facilitate that market. It was wildly profitable. What I hadn't realized when I made the jump was our firm, in addition to being a municipal bond powerhouse, also made markets in most of the Mid-Atlantic small regional and community banks, and this was like a gold mine. You know, we had one of the best traders in the business, a fellow by the name of John Boo, I believe he's still with Chapman Securities up in the Baltimore area. This guy was a genius bank stock trader. He was phenomenal. He could dig up the stock at a very attractive price so we could put it back out to the client at a very nice profit for myself and the firm, and the client was also in an excellent position to make money. Following the S&L crisis, these were all these well-run little banks trading at 50 and 60% of book value because Wall Street, as it always does, had thrown the baby out with the bathwater. Most of the small banks had no exposure to junk bonds or international loans or anything like that. But if the sector went, they all went in the aftermath of that crisis. So we were buying these stocks at incredibly cheap prices for our clients. And over the years, they made just an enormous amount of money as inevitably consolidation began to happen. Once you had the interstate banking regulations changed, bank consolidation really took on a life of its own, with the number of banks in the United States peaking sometime in the late 1980s, and the decline has continued. We've gone from over 14,000 banks to less than 7,000 banks today. That's going to continue, by the way, going forward. If anything, as we'll talk about, it's probably going to accelerate a little bit over the next decade, which, again, leaves us in a situation to make a lot of money. Now, these little banks on their own are just absolute money machines. They're not making exotic, risky loans. They're taking in deposits, putting the money back out in the form of loans, and they make money on the spread. They're compound, interest machines, basically. So earnings tend to go up along with the economy and the real estate markets in local areas. Usually some 10 to 15% a year. They're buying back stock most of the time. So you get really solid growth out of these things in normal times. Now, you do get events like the banking crisis starting in 2008. However, I got to tell you, you can see these things coming from about 3 miles away. First, bank valuations get very expensive. We in 2007, even late 2006, I wrote about it. You were starting to see bank valuations at 1.75 to 2 times book value. Takeovers were happening at more than 2.5 times book value. So valuations were simply excessive, which would lead us cutting back quite a bit in the spot. By the end of 2007, we were pretty much completely out of it because we were seeing the loan loss rates tick up at these banks, and we were seeing some ridiculous loans. You had the Alt-A and the no-doc and all that garbage going on, and just the collateral values were getting dangerous, so we pretty much cut back our exposure. Yes, there are problems in the industry from time to time, about once a decade, but really you can see them coming, and you're mostly in cash in a small bank portfolio by that point in time. Most of the time, these things just sit there. They're compound interest machines for long-term patient investors. Now, right now, we're not really in normal times. We're in something that looks a lot to me like 1992, 1993. And let me tell you a story of just exactly how this process can work for you. I had a friend and client back in Maryland, back in those days, who bought one bank, okay? And the one bank was a very high-quality local bank. And really nice returns on equity, had provided lots of growth, created more than 1 millionaire in town, by the way. Now, eventually, that bank, as part of the consolidation wave in the 90s, got taken over. And a couple of years later, that bank got taken over. Flash forward a couple more years, that bank got taken over. And then finally, there was one last takeover. I believe as we neared about 1999. My friend eventually sold those remaining shares, I believe, in 2007. His total return was something like 30 times his original investment from that roll-up of takeovers. One bank would take over another one. They'd grow for a couple years. They'd get a premium price from another bank, grow for a couple years, and then so on and so on and so on. The takeover wave, literally, the average bank went up by a factor of about 10. Those that got caught in one of these roll-ups were up to 20 to 30 times your original investment. Just an enormous amount of money to be made from this extremely boring little sector of the marketplace. Now, just to give you an example, and I wrote this in an article on Real Money last Saturday for the open house weekend. Let's just take a look at what can happen with these small banks. Let's say we find a little bank and it's trading at $8.50 a share, has a book value of $10. So it's trading at 85% of tangible book value. Now, Chris Marinak at FIG Partners told me the other day that he thinks these banks, especially those in his universe, can grow their book value by about 7% a year. So we've got our little bank. It grows book value by about 7% a year. Now, right now, takeover premiums are 1.35 times book value on average. So if that bank gets taken over 3 years, grows 7% a year, gets taken over at the current multiple of 1.35 times, we make about 24% a year on our money. Not bad. However, takeover premiums have been going up by about 5.5% a year. So if we say that the takeover premium continues to go up, it reaches 1.6, we now sell that bank at an average annual gain of 33.01%. Not too shabby, and that's just happens all the time, actually, and we're starting to see a lot of it even in our portfolio. I think we've had 15 takeovers at pretty nice gains over just the 2 years that Banking and Profits has been in existence. Now, let's say that you've got really average management. They don't grow book value, and it gets taken out at 1.35%. So you only make about 14 14.5% a year under that scenario. That's about 40% better than the long-term average of the stock market and beats the pants off of 90 to 95% of all money managers out there. This is a very lucrative place to invest your money. Now, people will tell me they're boring, they're not exciting, they hardly ever trade. Fantastic. That's exactly what you want to see happen. You're not competing with the large institutions. You're not moving in and out of the stock, paying constant vig in the forms of commissions and bid-ask spreads. You're just sitting there holding the stock and letting time and compounding do the heavy lifting for you. In Roger Ibbotson's study on liquidity, he found that the less liquid value stocks from 1976 all the way up through the end of last year, I believe the study was, earned about 18.2% a year, while the large liquid growth stocks only returned about 2.5% a year. It's a massive advantage to buying illiquid value stocks, and the description of those is small community banks and some of the smaller regional banks. They tend to trade very cheaply in relation to book value, and they are fairly illiquid. So they're designed for long-term investors, not for short-term traders. And the money is in the long-term end of this thing, not trading in and out of stocks on a daily basis. But now, another thing that's happened, and this over, say, the last 15 to 20 years, we've seen a whole new breed of investors spring up, and that's activist investors specializing in community bank stocks. There's a handful of them out there. Those that are there are very good at it, and they're extremely successful with very high hit rates, we'll call it. You know, there's like about a third of the banks that they target actually get taken over. Many more go up because they push management to do things like increase dividends and buy back stock that helps push the stock price higher over time. Brokerage firm Sterne Agee last October did a study, and they looked at a bunch of banks over the last decade that were community banks, and an activist had filed a 13-D declaring a 5% position, and that they were in fact going to take an activist approach and engage with management in an attempt to unlock shareholder value. Now, these banks during the holding period, from the time that the activists got involved until the time that they sold, outperformed the NASDAQ Bank Stock Index, outperformed the index by 28 full percentage points. The index itself during the holding period returned about 17% a year. That is a massive return to patient investors who are willing to buy about the time that the 13D is filed and hold until the activist situation is resolved. And these guys aren't Carl Icahn. It's just me and a couple other guys tracking their activities and watching their federal filings. There's not usually a pop in the stock when the 13D is filed. You're usually able to get your money in pretty much right alongside it, around the same price as the activists, and then sit back and let them do all the work pushing that stock higher for you over time. It's an incredibly lucrative way to invest. Can't believe more people don't do it. It's boring, it's illiquid, and I guess the less people that do it, the more money those of us that specialize in community banks will make over time. But let's just look at what's going on with our portfolio. Now, I just went into the portfolio page and I checked everything out. Year to date, we're up just about 10%. Over the last 52 weeks, we're up, it's about 15.5%. Now, compare those numbers to what the market is doing so far in 2015 and over the last 52 weeks, and we're just absolutely crushing the market. We've had about 15 takeovers with an average profit of about 55%, and that includes our bonus picks, by the way. Those that we don't include in the portfolio because they're just too small to guarantee that everybody can get a position. But 15 takeovers. We've had 9 closed positions, and the average gain on those now is about 60%. This isn't a 2-year time frame, guys. Banking on Profits is only 2 years old as of the end of July. So 9 closed stock picks, and as I said, average gains is about 60%. 77 out of our 79 stocks that have been in the portfolio during this period of time are up. We have 2 losers, and our biggest loser right now is down a whopping 1.5%. That is an outstanding batting average. The slugging average is even better because almost 50 of these are up double digits since the original purchase. And remember, we really didn't get fully invested in this thing until about January of 2014. We just kind of eased into the stocks the first 6 months of our operation of the newsletter. So we've got this wildly profitable portfolio of little banks. Our buy list went out this past week. The average price to book value was about 0.82%. Almost all of them have an activist investor present in the stock. Non-performing assets are well below the national average, and our banks are extremely well capitalized with equity to assets ratios that are well above the national average. So this is a pretty safe form of investing. We're buying small banks with solid loan portfolios and excess capital. We're buying them alongside an activist investor at a discount to tangible book value. It's pretty much a win-win recipe for long-term patient investors. Now, we've had a great deal of success, and I talked about this a little bit in a previous video, but we have to limit kind of our pool of people that are involved in this thing. We can't have hundreds of thousands of subscribers. So we're raising the price back up to the original offering point. We're locking initial subscribers in at the current $399 a year. That's our early adopters. They've been with us. We've made some money together. They've been very loyal and contributed some awesome feedback. So they're locked in at $399. End of this month, we go back up to $1,000. Again, looking to limit our pool of subscribers to serious investors who understand the advantages of investing in these illiquid small community bank stocks. So I'm also, for those of you that have been on the fence, that have been thinking about it, we're going to give you till the end of the month to sign up for $399 as well. I think that's pretty fair. A lot of people have been thinking about it. Maybe I will, maybe I won't. But it's a pretty good package. You get a weekly commentary on the portfolio, the stocks in the portfolio, update notices of earnings and buybacks and dividends, insider buying, 13Ds filings, whatever's going on with the stocks in the portfolio. We'll stay on top of that on a weekly basis. You also get buy and sell alerts anytime I buy or sell, and I don't sell often, as you can see, 9 stocks in 2 years. Most of this is a result of a takeover offer. You'll get a text alert or an email alert or however you choose to receive the message so you can act in a timely manner. You also get included free our regular Banking on Profits monthly newsletter service that, again, broader industry overview. We do a couple of what I call focus banks. This past issue, we looked at a bank that I think is going to grow at a very rapid rate because they're in a position to acquire a lot of banks going forward, and they've already done so, and they've been very smart about it and built a substantial franchise when just starting the bank as things fell apart in 2009. So that was one. Then we had a guest commentator, Nick Tovik of Complete Bank Data, came on, and he featured a smaller bank from up in New York State that it's a takeover target trading at around 75% of tangible book value. So you get a couple of focus stocks. We do an overview of the industry. Bill Moreland of BankRec Data has allowed us access to some of his bank overview and big picture stuff, so we're including that in the monthly issues going forward. And that's all part of your regular subscription at the $399 level. And of course, you have pretty much instant email access. I'm pretty good about returning emails in a timely fashion. They may just be one-liners if I'm real busy, but I'm certainly open to engaging in conversations about the opportunities in small bank stocks with my subscribers. So that's pretty much what I've got for you. We've proven our point. We're making money for our subscribers. We're seeing fantastic results. The newsletter's worth probably more than $1,000, given the amount of work that actually goes into it every week and every month, providing you commentary, updates, and stock picks. But we're going to price it at $1,000, but you've got 2 more weeks to get it for just $299. Yep, these stocks are boring. They don't do a lot from time to time until you get a takeover announcement or a big buyback announcement or some other piece of news that drives the stock. They can be a little bit boring. Day to day, it's like watching paint dry. Year to year, it's like watching your bank account grow. So Banking on Profits is probably going to make you more money than anything else that you can do in today's market. And we don't care what the Fed does. We don't really care too much about the news flow. We can't do anything about day-to-day market risk, but these stocks tend to be in very strong hands as there's activist buyers, there's local business leaders that own the bank. These banks, in many cases, the executives of the bank tend to own a lot of stock, as do the bank's retirement and employee stock ownership plans. So they're not getting dumped out to meet a margin call at the early stages of a decline. They see far less selling pressure and movement from day-to-day market volatility than other segments of the market. So this really is a win-win segment of the market. It's one that even if you're racking up trading gains and you're in that rare 1/10% that's a successful short-term trader, you should be plowing some of your profits back in to the type of stocks that we buy in the Banking on Profits report. Got 2 more weeks left to get this thing for $3.99. I highly recommend that you do so. It really is the trade of the decade. It's going to go on for at least that long because as you look at these little banks, even the best run of them are having a very difficult time keeping up with higher regulatory costs as a result of the Dodd-Frank laws. And now we have a potentially even more costly issue, and that is technology. And it's not just upgrading everything to mobile. It's also cybersecurity, which is going to be a very expensive problem for banks to deal with. The only way to deal with these costs is to gain scale and spread the costs over a larger asset base, which means these small banks need to look for a merger partner or somebody to buy them outright. And that's going to make us an absolute ton of money over the next 10 years, and I hope you join us. Anyway, this is Tim Melvin of the Banking on Profits newsletter, coming to you from down here in sunny Central Florida today, and we'll talk to you guys next week.